Welcome back. Now here's a scenario for you. Invest a great amount of cash with a fund manager. The return's pretty poor, but you're not sure why. Simply because you can't access detailed information about the underlying asset. That scenario is facing many investors. It's partly the reason behind the emergence of so-called separately managed account platforms. The concept of an SMA itself is nothing new. Plenty of brokers offer the service, basically allowing an investor to access a portfolio of shares selected by a broker or fund manager, but they still own the individual shares, not units in a fund which owns the shares. A separately managed account platform similar but with hedge funds. Rupert Lea is from the MAG Group, which operates one of those platforms, joining us now in the studio. Rupert, a warm welcome. Just explain how this one works.
Well, we advise institutional investors on setting up segregated or separately managed accounts. These accounts allow them to keep control of their assets in alternative investments and to see on a daily basis what is going on in each of the funds. So you literally can see every trade every day, and you can get monthly independent valuations, which means you remove mispricing risk, you can remove style drift, you can remove concentration of risk, you can remove over-leverage from the situation.
Let's be honest about it. This is not a fund for everyone, because I'm assuming there are fees, some quite sizable ones that are attached to all of this to give you that privileged access. Who are you really targeting?
This is primarily for institutional investors. Institutional investors invest in hedge funds to get diversification of returns in their portfolio, their overall portfolio. And to do that, they must be able to monitor what the hedge fund manager is doing. The problem with hedge funds is you're making your investments largely based on historical returns. Once you give them the money, you can't see what's going on. And if you can see what's going on, then you can remove the hedge fund manager when they start to correlate with the other parts of your portfolio, and therefore not do the job that you want them to do. So you're looking for absolute returns and diversification of assets.
How do you define not doing the job you're wanting to do? Simply that you're not getting the return on month, and therefore it's tantamount to a redemption?
Well, hedge funds, once you give them the money, are blind pools of assets, and effectively you don't know what they're doing with your money. So if you're looking for an absolute return, you want to monitor how much of the return is coming from alpha, genuinely produced by the hedge fund manager, or is in fact beta, i.e. market return just leveraged. From that point of view, a segregated managed account can give you a good clue of what's going on.
I think one of the things here that we're seeing in the industry is this push towards transparency. And
we were pushed into it, you mean?
Well, I think concerns over the last year or two, as Rupert says, you put your money with a fund manager. I mean, you've done your due diligence on that manager, so you know which asset class they're in, and you get a monthly report from that manager. Madoff sort of stuffed things up for a lot of fund of funds, but
because people did due diligence with him.
Sure. Well, some did. But the fund of fund problem was that you put your money into a fund of funds and they allocate to 20 or 30 or 40 separate managers. And I think that's the great benefit of the separately managed account, is that instead of having this blind pool of managers, you can actually see where the money is and whether there's correlation. One of the dangers of the fund of funds is that you might have 10 managers in there, all who have the similar position. So that's when you get very heavy correlation. If you can see that, you can either put an overlay across there, or you can say, no, we'll reduce our exposure to that manager.
Clarify that one, because you say, Rupert, in the literature that the hedge fund manager can still execute his strategy, operative word,
Absolutely.
As normal. When
you set up the managed account, you agree with the hedge fund manager what the parameters are within which they operate, how much leverage they take, how much concentration of risk they take, how many types of traded instruments they can and can't buy. If they move outside that limit, you have the right to redeem your money. And because you have control of the money, you can do so without even speaking to the hedge fund manager. If something's going wrong in a hedge fund, you can be sure that the hedge fund manager knows about it. Therefore, they may not take your call.
You don't look terribly convinced then, or you were agreeing, or what were you doing there?
Oh, look, I think that has been a problem in the past. I think it can be a bit of an overgeneralisation. I think due diligence is the key to this. You've got to do good due diligence.
Absolutely.
And I think we're...
But I mean, okay, but in fairness, you were saying, Rupert, a lot of these are blind. I mean, a lot of these are blind operations.
We look at it like this. Due diligence is like a still photograph. You take a picture at any period in time. You can go in 2 or 3 times a year, 4 or 5 times a year, but it is still just a still picture. When you've got transparency every day, it is like a video or a CD. You can see what's going on every day. Therefore, you can see the risks being taken in that portfolio change on a daily basis. And it may be that the risks are getting too high for yourself as an investor.
So
you just don't like the risk.
You talk about a segregated account. How is that actually handled? Can you just walk me through that one?
Well, the hedge fund manager is the trading advisor. They don't control the assets. The assets are held by the prime broker, and the money flows are controlled by a custodian. And you, as the investor, still keep control of the segregated account. So it's ultimately still your money. It is not in the commingled hedge fund vehicle.
What are your fees, just back to that thorny one again, what are they going to be alongside some of your competition?
Obviously, it depends on the amount of money. I mean, I would say that. But if you're talking
sort of
pro rata, you're probably talking about no more than 30 basis points, including a risk management system that looks over 360 different risk parameters every day on the portfolios that you have and managed accounts.
Over time, is this a sort of a seductive argument to say, look, all hedge funds should be running like this, that this would do away with the knee-jerk rush to legislate and regulate, and that we could, in fact, you know, self-regulate through a mechanism like this?
I believe that's the case, and I believe that regulation, certainly in Europe, regulation on hedge funds is going to increase enormously.
Chris, well, how's the lie of the land here? Is this something that you can see getting traction in this market?
I think it will, as an alternative to institutional fund of funds. And I think that's the real key. If an institution wants to invest in single managers, then they can get pretty good transparency. As far as Rupert says, they can get good transparency, they can get daily pricing, etc., you know, with agreement with the fund. But in a fund of fund, it doesn't work that way, because you're saying, right, well, as an institution will say, we'll allocate 100 million or 200 million to this fund of funds, and the fund of fund manager may get transparency into the underlying funds, 20 or 30 or 40 different funds, but the investor doesn't. And I think that's the great attraction here. And the fund of fund model came under severe pressure last year for lack of transparency, lack of liquidity, lack of any underlying control of the manager. It was the fund of funds that had to put up the gates, and it was the large fund of funds investing in the large managers that put up the gates.
And that's another point. Segregated managed accounts aren't gated because they're not in the commingled vehicle. So you agree the liquidity terms with the fund of fund manager or the single hedge fund manager in advance, and that's usually monthly.
Gentlemen, we are out of time. I do appreciate you, Rupert Lea from MAG Consultancy, the MAG Group. Appreciate you coming in. And, of course, Chris Gosselin. We'll see you next week.
Nice to see you, Carson.
Appreciate it.
Thank you.
That's the show.